mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. Very excited for this episode. We've got a returning expert joining us.
Yeah, our expert investors can't keep away from the show. So good to have this guest returning because I think it's at a sort of critical time. You know, we started 2020. Interest rates are really low at the moment.
Potentially getting lower. And, you know, keeping your hard-earned cash in the bank is returning next to nothing. Yeah.
So, you know, in some instances, just like my housemate, I think it's giving him 0.05%, which is less than inflation. So he's actually losing money sitting it in there. So I guess, Ren, what does that mean in terms of how do we find yield as an investor? Having said that, markets are at all-time highs at the moment. Sentiment is to be cautious. So I guess as a beginner investor, it can be a bit difficult to know where to put your money at times like this, which is why today we are joined by Daniel Foggo from RateSetter. Daniel, thanks for joining us on the show.
Thank you, gentlemen. It's a pleasure to join you again.
So Dan is here today to give us a bit of a brief on RateSetter, explain to us what they offer and how RateSetter might be a good option for our cash, Ren. We have had Dan on the show before, but, you know, the environment has changed since we both spoke to him last, and we wanted to sort of catch up with him to get an understanding of where RateSetter is now at and I guess the options that it gives investors for their cash. So looking forward to getting stuck in.
Yeah, we've named RateSetter a lot of times. There's probably listeners out there wondering what RateSetter is. So we might kick off, Dan. Can you tell us a bit about yourself and then a bit about RateSetter as well?
Sure. Look, very simply, I guess best described as a reformed banker. I used to work in corporate finance and initially in the UK and then latterly in Australia. And part of my role was to actually lend money to corporates. We did that in a way where actually the bank was losing money. The corporate wasn't actually getting a great deal. And that's when I thought really that model is not necessarily working so well when, you know, people are getting very low returns on their money in the bank. When they're borrowing, they're often paying high fees and reasonably high rates. So that set me on a course to look for an alternative. And through that journey, we created RateSetter.
So I guess that leads to the main question. For those that haven't listened to our previous episode and are new to the show, firstly, welcome and thank you for joining us. But what is RateSetter?
So we describe ourselves as Australia's leading technology-led investment and lending platform. So there's really two components to our business. First, we lend money to people, and we lend money to credit-worthy borrowers who are borrowing for a personal loan, renewable energy loan, or an automotive loan. We are one of the largest players in each of those markets in Australia, although only launched our business 5 years ago. So growing very quickly, and that's just really as the world's becoming more technology focused, we can offer a really good, fast solution to our customers. Then on the other side of the equation, we have a very broad set of investors funding the loans, the money we deploy to our borrowers. We have 20,000 investors funding our loans. So we in many ways see ourselves as an investment manager. It just so happens that we put money only into consumer credit.
So I guess for people who are trying to conceptualize it, it's a two-sided marketplace. You bring together both lenders and borrowers, and you use technology to do it in a way that's more efficient than your traditional banks, and so you can give better interest rates to both lenders and borrowers. Is that?
Would you like a job at RateSetter? Because I think that was a much better description than I gave. That's absolutely right. That is a very good description. The objective, of course, is to use technology to pass on really good value to our customers. Investors earn much higher returns than they might through a bank, although it's a different offering. It's not risk-free. We can talk about that a little bit, but we think it provides a nice middle ground between, you know, cash and bank and the equities market or property market. And similarly for our borrowers, they can save money as well. So over the life of RateSetter, you know, our investors have made about $40 million more than if they had their money in the bank account, and they've received every amount of interest and principal due to them. And our borrowers have saved about $40 million versus if they'd gone to, say, a Big Four player to borrow money.
Wow. So I guess before we get into the detail of RateSetter, it would be good to understand a bit about the journey, because you're being very modest there, but you RateSetter won Australian FinTech of the Year in 2016. You yourself won Australian FinTech Entrepreneur of the Year in 2017. So this is your chance to have a bit of a humble brag and tell us about the journey and, you know, where you are now.
Yeah, okay. Well, I mean, I guess where a brag might be is I think we were pretty early to see when we launched, or when we were speaking to the regulator before we launched, the term fintech was just not even heard of. That was back in 2012. We really broke down a lot of barriers in terms of engagement with regulators. We got a license to allow retail investors to invest in loans that we're funding. And, we launched in late 2014 after 2 years of dealing with regulators and getting set up to operate our business as the first business that was actually had a license that allowed people to invest, to fund a very established asset class, but in a new way. So during that time, over the last just over 5 years since we initially launched to customers, we've grown significantly. We've funded in aggregate just under $750 million of loans on a monthly basis. We're funding over $30 million a month, growing quickly. So we really see a lot of opportunity going forward, and in terms of both growth and delivering value to our customers. So we'd like to think we're a reasonably relevant part of the financial system and have a lot of good growth potential going forward.
So some of that growth is coming from Ren. He's actually
full disclosure.
He is a user of RateSetter from the investor side, unless you've taken out a loan for the car that you've
just
wanted
the investor
to buy.
side. Yeah,
the investor side. I was chatting to my housemates about it last night, in fact, because as we said at the start of the show, they've realized how little return they're getting on the money sitting in their bank. And you mentioned, Dan, there that you've now got some 20,000 retail investors on board or thereabouts. What is it do you think really appeals to investors? What's RateSetter offering that is making it attractive?
You nailed it when you introduced this discussion. And that's really, we're in a low rate environment. And that's not a critical component of our business model, but it's certainly helpful in terms of building awareness and people starting to invest with us. I think the next component is, what is the yield difference? You can invest with us in what we call our 5-year lending market. And the return today is about 7% on an annual basis. That's an attractive return, we believe, for the risk that one's actually taking on. We provision an amount of money when somebody borrows from us to cover any late payments and defaults. So when you invest with us, you do benefit from what we call our provision fund. That means that there's a sort of a buffer there for any late payments and defaults. And the good news is every one of our investors has received every amount of interest and principal due to them because of our provision fund. We're very diligent around who we lend to. We only lend to about 10 or 15% of people who come and apply for a loan with us. That means that, over the 5 years of our lending, our loss rate is below 2% of borrowers that have actually defaulted on loans. But our provision fund has covered all of those losses. And it's still got, a provision fund buffer still about $16.5 million, which is around 6% of the RateSetter lending platform loan book. So the way we'd characterize it is it's a modest level of risk for a really meaningfully higher return than what you might be able to get from a bank account, and meets that need where someone's looking to put cash for, say, 1 month to 5 years. We allow people to invest for those terms, and it helps people in that time when, they could be just wanting somewhere convenient to have cash for a while, where they're going to get a return. They might be saving up for a house, saving up for a deposit. And so it's somewhere worth, if you're going to purchase something in the next few years, you've got that money available to you when you need it. And then also, as I said earlier, Australians tend to be quite short on fixed income investments, tend to be very long in the stock market, long in property, and we provide diversity, give people exposure to what is actually a very large asset class in Australia, traditionally only been able to be accessed by banks and some other institutions, but it is a fantastic investment from a credit perspective or a through the cycle perspective. If we look at the last financial crisis, consumer credit performed especially well, particularly in the US and the UK, where the recessions were particularly deep. So we know it's a good asset class. It's typically been hard to access. We give people that access, we give them a good yield, and we give them that additional protection through the provision fund.
So I think people would hear 7% and be surprised, and if you compare it to interest rates at the moment, it is different. So maybe can you explain why people are able to get 7% here, and how it is it correlated to the Reserve Bank's interest rate and banks' interest rates? Sure.
I think if you take a step back and think around how consumer finance works through an alternative model, if you look at a bank, they take deposits, they pay between 0.05% in terms of return to the saver, up to 2.5% or thereabouts for some of the high rate accounts. But then they lend that money to consumers wanting a personal loan at traditionally around a 15 or 16% interest rate comparison rate. There's a lot of spread there between that deposit rate and the borrowing rate. So, and part of that's because there's actually quite significant overheads, and there might be branch networks and other things where you've got to cover that cost base. So through the use of technology, we're able to take out a lot of those costs. We're able to give the borrower a slightly better rate than what they might have otherwise been able to receive. And when I say slightly, on average for us, that's 3 or 4%. So actually quite a material amount of money over time. And then, so when by the time we've provisioned for losses and make some money ourselves as a business, we can still offer the investor a really good return. I'll probably slightly mischaracterize that, because when I say we offer the investor a return, we actually let the investors set their own rates. So if investors set rates, as I said, in our 5-year market today at about 7%, we'll get X amount of demand from borrowers. As soon as if that demand is really strong from borrowers, that might actually force the rates up for investors slightly until more investors put more money on. So it's quite a good equilibrium mechanism.
I think that's worth expanding on a bit because, as Bryce said, I am a user of the platform, and being able to set your own interest rate is quite unique. So can you just expand on how that works for the two-sided marketplace?
Sure. I think the best way to describe it is if one's familiar with a stock market, it's not dissimilar to that. It's just you as the investor, you're basically the one who's got money on offer. So let's use that 5-year market example again. If you put money on at 7%, basically we can then if the lowest lending order is at 7%, we'll be marketing loans to borrowers at 7% plus any fees and charges. So call it, 10% to the borrower. And so we're able to create significant demand on the back of that. As the borrower goes through their application process, they're then approved, they go to draw down their loan. And if you have the lowest lending order at 7%, your funds will be the next match to the next borrower that comes through. Probably haven't described that so succinctly.
No, it makes sense, and it gives the power to me as the user. I can say I need to earn 8% of my money, and I can put it in RateSetter, and if I can't get 8% matched, then I can walk away without putting money in. It's a unique proposition.
That's exactly right. And of course, we notify people if their money's been sitting on market without getting matched for so long, and we give a lot of data so that one, A, understands the credit characteristics of what they're investing in. They also understand exactly how much demand there is from borrowers at that particular time. So it gives one certainty and actually what the rates have been historically. So if you log on, you see the rate at 7% at the moment. The last match loan was at 7%. If you put your money on at 7% or 7.1, you probably get your investment in the next 24 hours funded.
Yeah, it changes the paradigm from a bank telling you this is what you're going to take and you're going to be happy about it.
That's right. It's really about empowerment and giving people control, giving them a lot of transparency around information. And, financial services is all about trust. So our journey to date has been about building that trust with our investors, making sure we've got a good track record, lending to the right sorts of customers, and then proving that up to our investors. So every quarter we release our loan book. We know people know how much money is in our provision fund at any point in time. Every year that we're lending, we explain how much we expect what loss rates should be, what they actually come in at. So, the way to build trust, if you haven't been in business for over 100 years, is really about transparency of information.
So if we jump back to the basics of what happens when I invest in RateSetter, I guess one of the traditional reasons people put money into term deposits and such was to get a form of fixed income. Mm-hmm. If I'm investing in the 5-year term, how does RateSetter provide a form of fixed income for the investor?
So if you're funding in the 5-year lending market, you'll be funding a borrower who is borrowing for a 5-year term. Every month that borrower will make a repayment, and that repayment will be part interest and part principal. So every month you'll get a proportion of your principal amount back, along with some interest. We then give you a lot of flexibility so that actually you can automatically reinvest the whole amount that you receive back every month, or you might just want to invest the principal amount and withdraw the interest into your own bank account. We also give people early access. So if you invest in the 5-year market, you actually can access your money early. There's a bit of criteria around that. We need to make sure there's enough money on market to fund new borrowers as they come through. But generally, all of our investors have been able to get their money out of the 5-year market if they have wanted to. So we added that you might call a liquidity feature about 18 months ago.
I'd be interested, Ren, what term have you gone?
I don't think I've done 5 because I always think I need the money before then. I think I think the bulk of it's in 3. Yeah,
okay. Yeah. People often go on a journey with us. We let people invest from $10. And I think that's been really important. We're looking to democratize finance, make it accessible to every Australian. And so, it's important people can access an investment without having a huge savings pool or investment pool. But what we do find is people then often start investing more money over time. They start investing in longer term markets. And actually, if you do the math on the 5-year lending market, if you were to pay, we do charge people, I think it's a 0.5% fee to withdraw their money, 1% fee to withdraw their money, or thereabouts. Check the PDS. It's only so many months of interest. I think it's 2.5 months of interest on average for you to actually recoup that. So if you think you're going to be investing for more than 6 months, it can be a sensible option.
There you go. I might have to get the calculator out and figure it out after this.
I think we should. Yeah.
Why do you think fixed income is important for a beginner investor in this market conditions at the moment?
Look, I think fixed income, if you look at a household investment portfolio in the US and other markets, there's generally a significant proportion of fixed income investment. I can't remember exactly what it is, but it's in the realm of sort of 20%. If you look at the average Australian household, that's not the case. It's less accessible here. Why is it important? I think it really comes back to the basics of financial theory. If people are familiar with the CAPM models around, maximizing your risk reward or your reward based on a certain amount of risk.
I'm going to say we're not familiar with it. So maybe if you can unpack that a little bit for us.
Look, quite simply, it comes down to, if you have a very broad portfolio, you can reduce the volatility of your returns. And if you can reduce volatility and increase your average return, then I think that's the combination one should be looking for. Low volatility, good returns. If we go through some specific investments like a stock market, they can offer high returns on average over the longer term, but within a certain time frame of, call it 1 year or 3 years, there's less certainty as to what that return will be. And actually, there's a probability that you may lose a significant amount of capital. With fixed income, one expects that there's low volatility in the return, particularly in the way we've structured our business, and it's a healthy fixed income amount you're getting back every month. So it's a way to hit that optimum curve in terms of your return versus your volatility.
So there's a number of fixed income products out there. How do you think about RateSetter in the fixed income world, and how should, everyday investors like Bryce and I think about it in terms of where it fits in our portfolio?
Yeah, I think it's quite hard for, most people to actually access various fixed income products. You often need a financial advisor. They're often really built for sophisticated investors, quite hard to understand, and often reasonable fees attached to actually accessing those products. What we've tried to do is provide an alternative, which is quite simple, easy to access, understandable. And so, there's not a real something I can contrast it with in the fixed income world. One can get ETFs, which might give some sort of exposure to some fixed income products, or, accessing something like government bonds and so on, or corporate bonds in Australia can be quite difficult for, retail investors. So really, I think the comparison is more with, be it stocks, be it cash in your bank account, or, property investment, for example. When we survey our investors, and we did do a survey last year, we found 70% of people that were investing with us had actually taken their money out of a bank account. It was about 10 or 15% had taken their money out of stocks. So that's really where we think of where one might be moving money from. It's not, another fixed income investment that people had other than a bank account.
Yeah, I think that's really important, because when you read, well, at least when I read financial media when I was starting out as an investor, bonds are another asset class that are spoken about in the same way as everything else, but they're inaccessible for most people. ETFs sometimes give them a nice wrapper, but in terms of actual accessible fixed income products, there isn't that many available to us. And I think that's probably what attracted me to RateSetter in the first place. Yeah.
One of the key differences with RateSetter as well is the provision fund, which you mentioned earlier. And I think, if you're starting out as an investor and you've got 2,000 that you've spent a long time saving, and you might think it's quite risky to go and lend that to someone on the other side that you have no idea what they're going to do with it or their ability to repay. Can you explain, I guess, in a bit more detail how the provision fund can protect an investor?
Sure. So we've had over 40,000 borrowers to date, and every one of those borrowers has paid some money into the provision fund, either through an upfront fee or part of their interest rate or a combination of each. So that's money, if they repay their loan, that stays in the provision fund. They never get that money back. It's part of a fee or a charge attached to their loan. So over time, of course, the provision fund keeps building up through those borrower payments going into it. So it sits in a bank account. It's held separate to our business. It's held by Perpetual as a trustee company. We have an ability to, if there's a late payment or default, make a claim on that provision fund on behalf of investors. So to date, every borrower late payment and default has been covered by the provision fund. So no investors had to receive an email from us saying, sorry, you're not going to get your money today as you expected, and that per the schedule we'd provided you with previously. So I think for investors, it's really important that we know it's important to investors that they understand how our credit's performing, how much money is in that provision fund, and it really gives them a sense of what the actual risk is in investing with us. It's about 160% of expected losses, and we have a reasonably conservative estimate of what losses are going forward. So we consider that a really good buffer to protect our investors. Even, we feel like we're really well prepared on a through the cycle basis to continue to give investors what they expect. So that's even in a deep, reasonably dark economic scenario like the financial crisis. We think we're in a good position to maintain that track record.
Can you explain that last a little bit more around performing through the cycle? Because I guess when you think about, a provision fund existing and you think about, economic times have been pretty good and unemployment's relatively low, why do you think that it will continue to perform well if, we hit a recession or equity markets fall and things aren't as bright as they've been of late?
I think the first thing to say is that we only lend to credit-worthy borrowers. So, it's reflected by the loss rate we've experienced to date. We're often lending for really good purposes like, solar panels and batteries where the customer's actually saving money. So that's a good position to be in when you're actually repaying a loan. Some of our loans or a number of our loans are secured. They're not just unsecured loans. So the first port of call there is really around the risk profile of our customers. The second is that actually most of our loans are relatively short term. The average term is about 34 months, so under 3 years. People do repay early. So actually, even if you are in a tougher economic situation, those repayments often come in faster because actually people are quite sensible and try to get out of debt sooner if it's a tougher economic situation. Whereas if it was a longer term debt instrument, if you like, that's a slightly riskier proposition. Our debt does pay down quite quickly. Then thirdly, I think we've got very good capabilities in-house around credit, making sure we are provisioning appropriately so that there is enough money in that provision fund on a through the cycle basis. Our head of credit, Simon Cordell, used to run the consumer component and then the business component of Amex in Australia, had a good visibility of what happened in a recession in the UK and the US when he was at Amex, where we can also lean on a lot of credit data from RateSetter, a sort of sister company, if you like, in the UK, where they've had over 700,000 borrowers, been through different economic environments to what we have been here. So we actually feel like we're one of the most capable credit businesses in the country in terms of pricing credit risk and making sure we are able to maintain that track record through the cycle. We will offer our borrowers have very granular risk pricing. We provision different amounts depending on the risk of the actual borrowers we're lending to. We have about 16 different risk buckets for our borrowers for personal loans. I think that's the most granular pricing in Australia. And, if one wants to get sort of nerdy around all the numbers, the rank order from day one when we started on each of those risk categories has fallen in the right order. Our models keep proving up. We've now got 5 years of our own data and that's performing in line with expectations. So we think we're doing a good job there. So we can get a good level of comfort.
If Bryce ever applies for a loan, you're going to need a 17th risk bucket, ultra high risk.
Right. My cash flow is as safe as houses.
It's worth adding also, when we lend to people, the processes that we go through are actually not dissimilar to a bank. And, we go through the same verification exercise around what one's earning, what one's expenses are, the sort of financial balance sheet, if you like, of the customer. We verify ID, all of those sorts of things we do, but we just do it really fast and efficiently through the use of technology. And that means that we can turn things around quickly and give a good experience to that borrower.
Dan, I used to work in a bank as a teller while I was at uni, and the majority of the customers that came in were quite old who were using term deposits. They were retirees, kept, ticking it over. Very rarely did I see a millennial come in and put down a term deposit, probably because we were at uni and had no money.
Invested in Bitcoin. Yeah.
I'm just wondering, what does the sort of customer base of RateSetter look like? Do you have many millennials on board?
Very good question. Actually, what surprises most people is that our average borrower is actually older than our average investor. So average borrower is 41, our average investor is 38. That does mask a few things. Our investor mix, we have a lot of millennial and relatively young investors, but actually the people who often invest a lot more money are, as you might expect, sort of pre-retirees or retirees, and sometimes investing via their SMSFs. Our average investment on the platform is about $20,000. That skews a really significant range from a lot of people with relatively small amounts through to some people with many, over $1 million of investment on the platform. We also have some institutional institutional investors, the government's funding via the Clean Energy Finance Corporation, our renewable energy loans. We have a superannuation fund funding some of our loans. We have a number of banks investing alongside our retail investors into some loans. We have some fixed income funds. So there's a broad range of investors. For our borrowers, we lend for many different purposes. The average, income of our borrowers is about $84,000. The average age, as I said, is 41. The reasons people borrow are very diverse, but regular loan purposes or common loan purposes would include, home improvement, buying a car, debt consolidation to save some money, tidying up your finances before you go and do a mortgage application or something like that, for example. We lend to cover some fees in some instances. And we think that's important, having a really diverse range of borrowers so that, you've got a lower risk loan book.
And so just to be clear, you mentioned there that the average investing amount was $20,000, but
Yes.
you can start with as little as $10.
You can start with $10, and we often see people start with $10 or $100, and then we might find after a few months or after a month it's $1,000, and it builds up from there. So we typically see over a 2-year period, people will build up their exposure once they decide exactly where they want to be investing, and they build comfort with our model, and they see their interest in principal coming back every month.
There's a wide range of people on the platform, and we understand why, the people with $10 to $1,000 investing in this, this is an easily accessible fixed income option for people. It's interesting that people with, $1 million plus on the platform are still choosing this as their fixed income allocation. Why do you think they're staying with the platform?
I think it really goes back to that sort of portfolio theory and making sure you've got diversity. And I think what really differs between the maybe younger people investing for a relatively short period of time is the term that they're investing for. And I think we've set up our business to cover both sets of needs. There's that you can invest in our 1-month market or 3-year market. Relatively short term, you get access to your money after a month in the 1-month market. And so, that generally suits younger people, but the return is lower. And then the 5-year investment market with a return of around 7% is obviously attractive to people who are really looking for yield, investing for a longer period of time. We often say, investing it for up to 5 years, but what we do know is a lot of our investors invest in the 5-year market, keep reinvesting the full amount of their capital and interest every month, just really trying to build a nest egg.
For a millennial who's looking to save for a house deposit, I don't know if you're going to be honest about this, but is this something that you would recommend they use as a way to sort of build their wealth to do so?
I think it makes a lot of sense as part of a diversified portfolio to have an investment with us. I think it's important to point out we're not a bank. One's not covered by the financial claims scheme. So one should certainly look at our data very closely, get comfort with our model, with our credit expertise. But, from where I sit, I, of course, am of the view that actually if one is saving for a deposit or investing for a deposit, our offering is a sensible place to have part of your portfolio.
And so just to be clear on that, let's just take a practical example. I get paid monthly or even fortnightly, for example, and I want to be putting, 20% of my pay towards a saving rather than putting it into the bank. Every fortnight, I can actually just put it into a 1-month term with RateSetter.
That's exactly right. And what we do find is, you get different repayments at different times from borrowers. You end up investing in loans with, literally hundreds of borrowers over time. So you get a really good diversity in terms of who you're investing with. If you then want to start withdrawing your money, within 30 days, you should have all of your 1-month investments back. So, we think it works well for people who, generally, if you're going to go and buy a property, you've got some reasonable visibility around exactly what the timing is for being able to pay.
And so the reinvestment of the principal and interest that gets paid at the end of that month, is that just able to tick over for another month and it's a rolling effect? Is that how that works?
Yeah, you can set reinvestment settings. So you can we've got 2 different types of investors. Those investors who really like the data, really like the detail, they'll log on every day, get very engaged with the offering.
That's
I can see you smiling. and then we've got the other type who just like to set and forget, put on automatic reinvestment settings. They like getting their monthly email. We give them an update on their portfolio. And so there's the 2 extremes. We are actually introducing an app over coming months. I think that will really resonate with investors, probably particularly younger investors who are more in the app world. And I think that's certainly going to make it a lot easier around having things like alerts when rates move, when it might be a good time to invest. We have much faster payments going on and off the platform, so you can literally move money in and out instantaneously. So there's some really good improvements coming down the pipeline.
Nice one. There's one area that we've touched on it a couple of times, but I wouldn't mind getting a little bit deeper on it because I think Bryce and I both have said that sustainability is going to be the theme of 2020. The summer that we've been through has really cemented that. But even before, ethical investing has been it's been a real big topic in the Equity Mates community. You've touched a couple of times on the Clean Energy Finance Corporation and renewable energy loans. Can you just expand on that and talk about what you guys are doing in that space? And then if you've got any plans to sort of expand it in the future?
Sure. No, it's a very exciting part of our business. It's growing strongly. We saw an opportunity a number of years ago to offer loans for people investing in solar panels and home batteries for the homes. Historically, that finance or those products, if you're buying them, and they might be sold as interest-free, but really there was a cost attached to them ordinarily, and that the price you might be paying for the goods would be inflated. We wanted to provide something that was very transparent, good value to the customers, so that they could see that, what the interest rate was they're actually paying, what the real cost of finance was. So we introduced that offering into market about 3 years ago. That was very successful. As you mentioned, the CFC sort of cornerstoned that. We have grown really strongly since then. We are administering $100 million of subsidies in South Australia into homes to subsidise batteries. And we've got another $100 million funding commitment from the CFC to support that growth in South Australia. That's given us really good relationships with a lot of installation firms, battery manufacturing firms, solar manufacturing firms. So we actually sell through the point of sale finance. So, we don't market that product to people online, but it's really you come through those third-party channels. So that's providing a really good investment opportunity for people who want to encourage the adoption of renewable energy products. The CFC cornerstoned it, but they really are encouraging of other investors coming on board. So we've got we didn't anticipate so many mum and dad or retail investors would want to invest in this segment. I think the fires have certainly helped that interest. And so we're seeing more and more coming on board, investing alongside the CFC. So we see some great prospects for that growing. There's a lot of other state programs that are expected to launch over coming years. We would hope to have a role in those and give investors access to some other programs across the country.
So you could build your fully ethical portfolio. You could have ethical ETFs for equities. You could have lending to solar panels for your fixed income. Then you could,
Future Super.
Future Super.
That's right.
Find an ethical bank Australia or something.
Ethical podcast, Equity Mates.
Well, that's right. And actually, mentioning Future Super, they are actually investing into our renewable energy markets. So we do work together, common views on what we should be trying to achieve there.
So as well as the ethical side and the sort of growing interest in that space, is there anything coming down the pike that you can sort of tease us and our audience with in terms of future plans, new markets that you might be opening up or anything like that you're excited about for 2020?
I think the opportunity ahead of us is really exciting. This month we'll fund about 70% more in loans than what we did this month last year. So there's a really good runway to maintain good growth, we expect, over coming years.
Well, this podcast will give you another 70% right. Just off that.
Yeah. And look, we're obviously expecting that we will attract a lot more investors as we grow the lending side of our business. So we're very excited for the future. I think we're actually reasonably diverse in the channels we're in terms of consumer finance. So really it's just about scaling up and doing more of the same and making sure we're focused on exactly where we're growing. And that's a relatively low risk way for us to grow. It's a relatively low risk way for our investors to participate. So nothing radical in the next 12 months. I think there's a discipline in running an entrepreneurial business and ensuring you are focused rather than trying to do too many things.
Fair enough. No Elon Musk wild entrepreneurial statements about, going to Mars or anything like that.
No, we'll keep our space programs for another few years.
Well, Dan, as we started the show, I think hopefully it's become clear that RateSetter is a good alternative to sitting that cash in the bank. I know it irks me nothing more than seeing my housemate sitting on the couch and put all his money into the bank.
You brought your housemate up, I think, 3 times in this interview.
Honestly, because we
Are you going to name and shame him?
No. But honestly, we're at this stage in life where you should really be considering what you do with your money, and the environment we're in at the moment, it's frustrating to see him work so hard for it and then lose money just by sitting it in these institutions. So
that's right. One shouldn't really think of a bank account as an investment. It's for convenience.
Yeah. Well, he spends it on beers, but
that's an investment.
That's convenient.
But I think if you are looking for an investment that is not you think might be more comfortable than going into stocks or other forms of asset, then RateSetter is certainly something to consider given the return that you can get. It's got the provision fund to sort of alleviate that fear of risk. And look, they're absolutely growing. So you're in, Ren.
I am.
I'm going in.
Are you?
Yeah, well, I mean, luckily my return on my bank account is just above inflation.
Yeah. After that spiel, you have to go in.
I'm all in. So, Dan, we've got some good news. You've got a bit of an offer for our Equity Mates audience, which is fantastic for those that are looking to kick off with you guys.
Yes, that's right. We're running a special offer where if one invests $100, you get an extra $20 in your account. You can register at RateSetter, ratesetter.com.au/equitymates. And then the good news is we often have other referral programs in place over time. So as you bring more friends on, we will give both you, the referrer, and your friends additional bonuses. So there's a good way to get some kickers as you build up your investment.
Love a good referral program. So just to confirm, for any Equity Mates listening that want to get started with RateSetter, you're offering $100 investment from them. We'll see you put $20 into their account.
That's right. Up till the 31st of March.
Up to the 31st of March, 2020. And you will find that by going to ratesetter.com.au/equitymates. That's ratesetter.com.au/equitymates. And you can do all of that by just investing as little as $10. You won't get the 20 though if you do that. But don't let that detract you from starting.
That's right. And look, signing up is a pretty quick and easy process, even if one just wants to have a look and understand exactly how the sort of marketplace works, if you like.
And that $20 compounded at 7% over 60 years is over $1,000. So very generous.
Hey, not bad.
Classic. Yeah.
Well, Dan, thanks for your time today. Really appreciate you coming in and sharing what has been a good growth story for RateSetter, and we're very much looking forward to see what comes in 2020.
Thank you for having me. Can't wait to come back.
Thanks for listening to Equity Mates Investing Podcast, a production of Equity Mates Media. Please remember that everything you hear in Equity Mates Investing Podcast is general advice only. The content has been prepared without knowing your personal objectives, specific financial circumstances, or goals. The host of Equity Mates Investing Podcast may maintain positions in the companies discussed. Before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.